Welcome back to Financial Wellness Planning. My name is Derek Coffey. I'm the founder of FWP, and one of our goals is to bring to you the news articles that we think actually apply to you and your situations. Unfortunately, our news cycles are full of headlines that are meant to grab your attention, but in most cases, they're depressing or they're not very informative. So, my hope is that with this channel, we can bring to you the news articles that we think are going to be most applicable to you. Stay tuned. This article by CNBC is basically going over Treasury Chief Yellen being hounded by Republican senators about tax increases. And these tax increases are a concern due to the fact that the Tax Cut and Job Act that was passed under the Trump administration is set to expire at the end of 2025. If this were to happen, it's going to create quite a headache for many taxpayers. One of the nice things of the Tax Cuts and Job Act is that it made filing taxes much more simple for the majority of American taxpayers. Although the simplicity of filing your taxes may go away, it may not be as bad as it seems, especially if you earn less than $400,000 a year. The reason I bring up 400,000 is because President Biden and Republicans on the other side are very protective of that $400,000 number. There's a lot of people that make less than $400,000 a year. They also make up a large component of the voter base. So making sure that those individuals stay happy, and in this case, not pay more taxes, is going to be the goal of any negotiation that may happen between the two parties. The biggest issue with the Tax Cuts and Job Act expiring is the fact that it's up to our government to determine whether it carries on or not. We are all very aware of the efficiency or lack thereof of our government. And if you're new to this, then our government's not very good when it comes to efficiency in passing new laws. So to me, it's just safe to assume that the Tax Cuts and Job Act is going to expire and that we're going to revert back to the way taxes were in 2017. And I'm not saying that's what's going to happen. I'm just saying we should prepare ourselves for that to be the case. So what you're looking at on your screen is a guide that was created by FP Pathfinder. And this is the company that actually has created all of the checklists and the flowcharts that you can find on the FW Planning website. So big shout out to them for creating these. It makes everything a little bit more personalized for someone who's trying to find an answer to a certain financial related question. This guide in particular, it will be free on the website. So all you have to do is go in, search for it, and you'll be able to find it. The purpose of this guide is to show you the difference between taxes in 2017 and taxes as they are in 2024. What you'll notice is that the income brackets are all the same. Those have not changed. What has changed are those marginal tax rates. In 2024, your marginal tax rates are 10, 12, 22, 24, 32, 35, and 37. If the TCJA were to expire, those marginal tax rates become 10, 15, 25, 28, 33, 35, and 39.6. Although it doesn't seem like this would create a huge tax increase, it is going to create a tax increase on people that make $50,000 or more every single year. To give you an example of what this would look like, let's say we had a couple that were married filing jointly. In 2024, they make $100,000 per year. Under the current setup, they get to reduce this income by $29,200. Doing this leaves them a taxable income of $70,800. From $0 to $23,200, they're going to pay 10% in federal income taxes. This equates to $2,320. Anything that they earn over $23,200 all the way up to $94,300, they're going to owe 12%. For this example, there's $47,600 of their income that's going to be taxed at 12%. This is going to equate to a tax bill of $5,712 on that money. Their total tax bill in 2024 would be $8,032. If the TCJA were to expire and the marginal tax rates revert back to 2017, their taxes are going to look a little bit different. If they have the same $100,000 of income, they do get to reduce this income by the standard deduction, which in 2017 was $15,750. They will also get to reduce their income by personal exemptions. With the passage of the Tax Cuts and Jobs Act, the personal exemptions went away, and this made it easier for the majority of tax filers to file their taxes. And this was due to the fact that the standard deduction doubled from what it was at that time. If the TCJA were to expire, personal exemptions are going to be reintroduced into your taxes. So for this example, we'll assume that they claim the full $10,100 as their personal exemption. Now, if you add these two up, you'll notice it equates to about $25,850. This is marginally less than the $29,200 that you're receiving as a standard deduction now if you're married. So the changes there isn't that great, but it's the marginal tax rate that's going to make the biggest difference. So if we go through the same calculation, their taxable income is $73,150. From 0 to $23,200, they owe 10%, or $2,320. The biggest change is that the additional income that they have to pay taxes on is going to be multiplied by 15% as opposed to 12%. So in this example, they have $49,950 that's going to be taxed at 15%. This is going to add to their tax bill $5,994. A married couple that files their taxes jointly under the 2017 tax brackets is going to have a total tax bill of $8,314. So we're talking effectively $25 a month of reduced income, at least due to the federal income tax increase that this couple would experience. I have a strong suspicion that this will not occur, but for the sake of being conservative and knowing how our government operates, it's good to know how the expiration of the TCJA could affect you personally. And this is one example. Yes, it's only $25 a month, but that's still $25 a month that you're going to have to pay in additional taxes. You'll notice that the long-term capital gains tax, they don't change at all. They've actually stayed the same since 2017. The only difference is those income brackets have just increased with inflation. We've already gone over the change of the standard deduction in the examples that we went through, but those will change as well if the TCJA does indeed expire. The next big change that you're going to notice is in what's called the SALT taxes, or your state and local taxes, and how much you can actually deduct off of your federally taxable income for the purposes of determining your tax bill. Currently, under the Tax Cut and Jobs Act, SALT taxes are limited to $10,000, and this is most impactful to people that live in a high cost of living area that may be subject to very high personal property taxes, or even state and local taxes, places like New York City, where not only do you pay New York state taxes, you're also going to have the city tax as well on your income. Under the 2017 tax laws, that SALT deduction was unlimited. Another difference is that currently you can only deduct $750,000 of mortgage interest, and I say only fairly tongue-in-cheek. That was a $250,000 reduction from 2017, so it did affect the higher earners at least a little bit in the amount of mortgage interest that they could deduct. Charitable donations that are made in cash were subject to a 60% of AGI limit. In 2017, that was 50%. A couple of things that were lost with the passage of the Tax Cut and Jobs Act was the deductibility of financial advisory fees. If the fees that you're paying for financial advice are 2% or more of your AGI, in 2017 you could deduct those. As of right now, you cannot. One big change that the expiration of the TCJA will cause is the ability to deduct 20% of QBI. The basis of QBI is that a small business owner can deduct 20% of the profit that they report immediately on their taxes. I personally have been able to enjoy this deduction since the passage of TCJA. Losing that is going to cause a significant tax increase on myself as well as many other small business owners. So, if we take this away, in addition to the current labor market and the current economic environment that we find ourselves in, this is going to be a large headache for small business owners by losing that 20% deduction. A quick example of QBI is if you're a small business owner and you make $100,000 a year in profit, you can currently deduct that 20%, or in this case, $20,000. Now your taxable income is $80,000. And then you go through the process of deductions, etc. Currently, if a small business owner had to report this $20,000 as taxable income, their tax bill is going to be $2,400. 20,000, 12% marginal tax rate is $2,400 in federal income taxes. But the way things stand with the QBI deduction, small business owners don't have to incur this $2,400 of federal income taxes. If TCJA were to expire, they are now on the hook for the taxes on this $20,000. The only difference is based on the 2017 brackets, that $20,000 is going to be taxed at 15%. So now, as opposed to having a tax reduction of $2,400, they're now going to owe $3,000 in additional federal income taxes due to the QBI disappearing. The next difference you're going to notice is that currently the child tax credit is $2,000. $1,700 of that is refundable. Under the 2017 tax guidelines, the child tax credit was $1,000 and all $1,000 of that could be refundable. I personally would like to see them keep it at $2,000. I think it's very beneficial to those that have children that they can at least reduce their tax bill by $2,000 per child. I actually hope they increase it. Personally, I think they should increase it to $2,400 a year and then pay that out over the course of the year, just like they did during COVID, where every family would receive X amount per child every single month. It would actually make filing this credit a little bit easier because there would be nothing to file. The benefit would actually be paid out to the families. I don't want to spend too much time on AMT. Depending on how much money you make, your taxes are calculated two separate ways. You have your standard calculation, and then you have the alternative minimum tax calculation. If you make close to these amounts of money, then you should definitely be speaking to an accountant to make sure that you're paying the proper amount. The last big change that you're going to see is the difference between the estate and gift tax lifetime exemption. Currently, it's $13,610,000 per person. So if you're married, it actually gives you $27 million that you could pass on to your beneficiaries estate tax free. I personally don't care what they do with this exemption. One, because I'm not even close to $27 million or $13.6 million if I was living by myself. I think they could reduce it. They could drop it down to the $6.8 million under the 2017 guidelines, simply because people that have that amount of money, they can figure out a way not to have to worry about estate taxes. So they can do what they want with that. What I would like to offer is some type of solution. Now, understand that this is not a researched, verified plan. This is simply a common sense, middle of the road way that they could go about making these changes and still appease both sides of the aisle. The first thing that I would think would happen is that those first four tax brackets aren't going to change. It's still going to be 10%, 12%, 22%, 24%. Because this allows politicians to say, hey, we didn't raise income taxes on those that make $400,000 or less in a year. What they could do is then move the marginal rates from 2017 over into the current setup. So 32 would go to 33, 35 would stay the same, and then 37% would go up to 39.6%. Long-term capital gains, I doubt they're going to change those. They may, but I highly doubt it. For the standard deductions, I would actually like to see the 2017 come back into play. A lot of that has to do with the fact that a lot of middle America has purchased a home with higher mortgage interest rates, with interest rates being at 7% or so on a 30-year mortgage, that it's going to allow people to itemize potentially more than the standard deduction that they're getting now. So I would like to see the 2017 standard deduction and exemptions come back. Now, we have to remember, we have to appease everyone. So with the itemized deduction limits, the SALT taxes, they should just go back to being unlimited. It's going to help people that live in higher cost of living areas or those that are exposed to higher state and local income taxes. Mortgage interest, they can take it back to a million. Again, it's only going to help the rich, but so be it. Charitable donations, leave it at 60%. The more money that people are willing to give to organizations to better society, the better. If they wanted to keep the deductibility of financial advisory fees, that would be great. I don't know how many people are paying more than 2% of their AGI for financial advisory services, but when you're retired, there is a higher probability that you're paying more than 2% of your AGI. So I think that's something that they could bring back. QBI deduction, leave it at 20%. Child tax credit, definitely leave that at $2,000 with the $1,700 that's refundable. Alternative minimum tax, I would like to see them keep those income limits at their current. I think with the wage increases that we've seen, especially since COVID, reverting back to the 2017 AMT income limits, you're going to have a lot more people exposed to AMT, especially under that $400,000 limit. And then finally, like I said earlier, they could just drop the estate and gift tax back down to 6.8 million. That's 17.6 million for a married couple. Those individuals have the means to avoid estate taxes anyway. But to me, there's a lot of number crunching that needs to occur, stuff that's way above my abilities of crunching numbers. But I do think that the solution could be fairly common sense. I know that our government doesn't do anything really based on common sense. So it's something that we're going to have to wait and see. But understanding how this could affect you, especially if you make more than $50,000, whether you're married or you're single, if everything reverts back to the 2017 tax rates, you're going to see a tax increase. So understand these things, talk to your professionals, your legal professionals for estate planning, your accountant for your tax planning, and your financial advisor on what to do with your investments in regards to some of these changes that may be coming. The final thing that I want to let you know before I let you go is that there is another checklist that I will have in the Resource Center on the website for members. And this is much more personalized of things that you need to be considering before and potentially after the Tax Cut and Jobs Act does expire. It's all in this checklist, and these are all questions that you need to be asking yourself and all of the professionals that you work with. These are all things that you should be thinking about as these events unfold. So that's a wrap for episode number 1. Thank you so much for tuning in. When I come across another article, I'll get it to you as soon as I can. Until then, take care. I'll talk to you soon.